The last 3 months of 2013 were relatively placid on Wall Street. Interestingly, the day that many investors dreaded turned out to be the best trading day of the quarter. The Dow rose 292 points on December 18th when the Federal Reserve announced the oncoming tapering of its economic stimulus. The Dow gained 9.5% in the fourth quarter, and the NASDAQ and S&P 500 did even better. Mortgage rates increased, and the housing market cooled down a bit. Gold sank and oil rebounded. Consumers grew more confident about the economy, but also grew frustrated with both Congress and the Affordable Care Act. Arguably, the biggest headlines came out of the nation's capital. The federal government shut down for 16 days in October, and it just merely paused the bull market. Also, the House and Senate arrived at a 2-year budget agreement in December, quelling fears of another shutdown for January. The Fed elected to reduce its monthly asset purchases to $75 billion starting in January, with the chance of further major reductions this year. It made no move with interest rates. While the Congressional Budget Office projected 7 million Americans would sign up for their own health care via the health insurance exchanges, the reality was in the vicinity of 2 million due to technical difficulties. Additionally, 4 million insured Americans found out that their coverage was being canceled because it did not meet ACA standards. As for economic indicators, things seem to be clearly improving. The jobless rate was down to 7% in November. Q3 GDP was more than double its average since 2009. Consumer spending rose in October and November. Meanwhile, consumer inflation remained fairly flat. In foreign markets, key indices mostly advanced, even though economic indicators from Europe and China were decidedly mixed. The big stories in commodities was the free fall for gold and silver. Gold prices dropped over 28% on the year. Gold has not had a down year since 2000. Silver did even worse. The real estate market saw interest rates increase in the two most common types of home loans. As interest rates increased, year-over-year existing home sales decreased for the first time in more than 2 years. Shrinking inventory was a major factor. Still, the National Association of Realtors reported almost a 10% annual gain in the median price of an existing home. Looking back, all three major indices posted 4 consecutive monthly advances to close out 2013. Last year was the best year for S&P 500 since 1997. Could 2014 offer returns anywhere close to these? Almost no one thinks so. The consensus forecast is for a modest gain for S&P 500 in 2014. This year might bring the end of QE3 and we might see a stock market correction. We haven't had one in about 2 years, and historically, they occur about once a year. There's plenty of good news to consider, however. Consumer spending is improving, consumer confidence has increased, unemployment is lessening, the factory and service sectors are expanding, and the Fed's decision to taper didn't send interest rates through the roof. The average bull market lasts about 4 years, and this one will turn 5 in March. Yet, Wall Street seems confident that the bulls can keep running even as the central bank winds down its asset purchases. If stocks gain 10% or better in 2014, that will be another one of this bull market's numerous pleasant surprises. As always, we appreciate the trust you have placed in your LifePlan wealth management team. If you should have any questions, please contact your relationship manager.